So moving on to liquidity. Liquidity is again how liquid a particular stock or instrument is. By liquid I mean if I place a buy order, will the order be met soon? If I place a sell order, will the order be met soon? So there should be ample amount of buyers and sellers which are present in the market for your orders to be executed. Let's say you want to sell, and if there's no seller in the market, then there's no point of it, right? So that is what is known as liquidity. Liquidity is the ability to transact a meaningful number of shares or contracts easily without bringing about large price change. The difference between the quote price and the execution price is slippage. So that is what slippage is, right? The quote price and the execution price. So if you have a large slippage, then in that case you will face a lot of losses, which is not nice, right? So that's the thing. For stocks, volatility can be measured using ATR 14. A more complicated formula is necessary for futures because of the different dollar value. So okay, and then we have volume. Now issues which can be related to volume might also occur in the markets, right? So issues with constant heavy volume are usually issues that have liquidity, but they might not have sufficient volatility to profit. So they might be really liquid in the sense you might be able to execute your trades, but there's not much of a volume, because of which high movements or big movements do not occur. In that case your profit is minimized and you don't have like a big profit. Which issues should I select for investing? So there are a number of issues. How do we know which one we have to select? That's what we're going to see. When investing, the universe of potential investments is enormous. That means that some method should be used to call out the investments, determining those most likely to outperform the markets. In the futures market, selection is usually based on a ratio analysis of each future versus a basket of future or against other investment vehicle. Okay, so now let's talk about all of the methods. Okay, so right now to begin with, we'll be talking about two methods, and the first one is called as a top down method, and the second one is known as a bottom up method. So these are the two methods using which you can select the issues or select what you want to exactly put your capital in. So the first method, let's start with that. It is the top down method. So in the top down method, the whereby the prospects of the market and sectors are first determined. So first the market and the sectors, first the macro picture is taken into account, which is why it is known as top down. By top I mean that a more macro perspective. I mean I'm talking about the whole sectoral view or the whole market view in general. So which is why we are going to start on a top approach and then we'll come down. By down I mean we are going to more specialized or more something which is inside of the top, right? Down is something which is inside of the top, right? It's like which is a part of it, and then you go down into the niche and select what you want. So that is what is known as the top down method. The prospects for groups such as industry groups or countries are determined, and finally, after the decision is made that a particular market is favorable and certain groups are favorable. So, first you are going to see the entire market and you are going to select a particular, let's say, geography where you want to invest, or particular industry like you want to invest in. Like you're looking at all the industries. You're looking at pharma, you're looking at tech, you're looking at entertainment, FMCG, all of the sectors, and then you are researching on them and then selecting one sector from all of them. Let's say now after I've done the entire top research, now I know that I want to invest in the pharma sector. So then you go into the pharma sector and then you start filtering out the stocks inside of the pharma sector. So the first thing you're going to do basically is look at the overall sectors, and then first you're going to select where, in which area are you interested in. This method is more common in fundamental analysis and in professional management of buy and hold portfolios, where there may be little choice as to whether to be in the stock market or not. It is often called asset allocation, and the method we will look at. Okay, yeah. The second method. Now let's talk about the second method, that is known as the bottom up method. So this is literally the opposite of the top down method, right? Because what is a bottom up method? First you're starting in the bottom, which means you're starting with the stocks you are interested in. So the stocks are already selected on the basis of, let's say, technical analysis, or let's say by their earnings or cash flow or the business prospects or price behavior, anything. It can be any method. So bottom up, first you are choosing the stocks where you can see interesting opportunities to begin with, and then we'll see that when you have few stocks coming through the screens for performance, then what are you going to do? you are going to first select the stock. Okay, you're going to select a couple of stocks. All of them can be from any industry, it doesn't have to be from the same industry. And then the investor can assess what groups are performing well and whether the entire market is favorable or not. If few stocks come through the screens for performance, it is clear that the market is in difficulty. For example, and if many stocks meet the criteria, the market is favorable. So that's how you use the bottom up method. So I hope you understood what is a top down method and what is a bottom up method. Now let's come to what is the top down analysis. Okay, don't get confused between the top down method and the top down analysis. Let's go through them one by one. Top down analysis begins with the study of the major markets such as interest rates, currencies, commodities, and stock market to determine which market has highest possibility of profit in the future. Once a market has been selected, the next level of decision making is the groupings of issues in the market and finally the individual issues within those groupings. In the currency markets, the breakdown for US investors is basically whether to invest in the dollar or in a foreign currency. If it is to be if it is to one sec if it is to be a foreign currency, the selection is large and can be broken down into further groups. For example, the resource producing countries and the emerging countries. If the bond market is chosen, the groupings can be on the length to maturity, country and currency, and levels of default risk. In the stock market, of course, industry groups are standard sectors. So, what is a top down analysis? You're again beginning from the top, you're looking at the major market, you're looking at the interest rates, you're looking at the currency strength. If you're in the US, you're looking at the dollar strength and like the major aspects. So first you are going to see the macro economy and you're going to make analysis based on that, and then after grouping and after selection of issues, that's when you are going into the filtering of where you want to actually put in your money. All right. Um, the technical method used to determine markets' relative attractiveness is called ratio analysis. So, this what do you mean by relative attractiveness? How related are they, and how they basically move together or move against together? So that is what comes to um, that is what is basically ratio analysis. It compares different markets with each other. Hmm. So, with each other to see which is performing most favorably. After a market has been selected that fits the investor's objectives, further comparisons are made with components of that market. So, how you're going to compare, whether by capitalization, whether by profits or quality, industry group, or you can compare it with any way. Now, let's talk about secular emphasis. Now, what is secular emphasis? Let's talk about that. John Murphy, in his book of Intermarket Technical Analysis, discussed the concept of alternating emphasis in the markets on hard assets and soft assets over long secular periods. Now, secular is basically a term which is used for any period which is longer than the business cycle. So, you know about the business cycle, the troughs and like the booms, everything which comes in the business cycle, right? We've done that in the cycle analysis in level 1 as well. So, if there is a time period which is more than the business cycle itself, then that time period is known as secular time. Hard assets are basically solid commodities such as gold, silver, etc. So these assets, that they are used as a hedge against inflation, and the currency is basically backed by these kind of commodities, which are hard commodities or which are hard assets like gold and like silver. Soft assets are basically also known as the paper assets, and by soft assets we mean like stocks and bonds and stuff like that. So you need to really have a mix between both of them. You need to have some sort of hard assets in your portfolio, but you also need to have some sort of soft assets in your portfolio, or according to the timing in the market you need to keep alternating between the two. So that is one thing you need to keep in mind. The reason for this inverse relationship between the value of hard assets and of soft assets is that there is a close correlation between material prices and interest rates. I'll just give you a small example for you to understand this topic better. Now, let's say if the market is doing very well, then the stocks are going up, the bonds are going up, everything's good. In that case, people are willing to put more of their money in the stocks, right, in the paper assets or in the soft assets, because the market is doing well, the economy is doing good, so everyone's putting their money there. In cases like that, the hard assets like gold and silver, their prices come down because there is no demand for it, because everyone's optimistic and everyone's really happy with the economy and everybody's willing to put their money in the soft assets rather than putting in a safe or a convenient, comfortable returns which is given by gold. Now, let's say there's a panic situation in the market, whether there is a recession or whether there is a pandemic on a global level. In that case, people are very concerned and they're very scared. In situations like that, people take out their money from the soft assets and they put their money in the hard assets, right? Because now they just want safe returns because they know that the market is unstable, the economy is not doing good. So in that situation, people will start putting their money in gold because now they just want a safe, decent return. So that is why we are saying that there is an inverse relationship between the soft assets and the hard assets. Okay. Inflation or higher material prices is generally associated with higher interest rates. When inflation becomes a threat, paper assets which decrease in value as interest rates rise. Okay. Interest rates rise when there is inflation. Keep that in mind. Okay. So this is what I explained. You can read it if you want. As the theory states, when hard assets rise in value, soft assets decline. However, between 1998 and 2012, the relationship has not always been held. Gold is traditionally the measure of hard asset prices because of its universal appeal as an inflation hedge, and the stock market is a soft asset. Figure shows the history of gold prices and the Dow Jones since 2000. Look at this gold price. Gold has been steadily going up and there has been no significant correction. There have been small corrections here, but overall it's been going up. Whereas S&P 500, it has also risen. If you look at it, it actually went up, but then it came down, went up, came down significantly, went up again. So that's the difference between gold and S&P 500. Except major decline during the stock prices, except during the major decline in stock prices from 2000 through 2009 and a few other bumps, these two market characteristics uncharacteristically headed in the same direction. Indeed, over this period, gold outperformed the stock market. This action dispels the theory that they will always travel in opposite directions. Looking at a ratio chart of gold to the stock market, we see that clear trends develop in the relationship between the two types of assets. Figure shows a graph of ratio of gold to the stock market. Ratio of gold and ratio of stock. Look at that. You can see over here. Ratio smoothed over 3 months, moving average line 24 months SMA. This is a crude method of signaling and requires considerable refinement, but here is used for illustrative purposes. In figure, the last signal to switch from hard assets to soft assets occurred around May 2012 when gold was trading. Okay. Although these signals are not precise by any means, they do indicate over long periods in what asset type the investor should be invested in. Once a definite trend towards one or other asset type is clear, it usually remains in place for many years. Even though we have used gold as an example of a hard asset, thus far gold is not necessarily the best hard asset. Other exits like oil, copper, aluminium, etc. These are called as industrial raw materials or industrial methods and are normally associated with business cycles. Obviously, for example, you know that how the airline industry, right? It functions, and it's the major consumer of crude oil, right? So obviously the crude oil prices affects the business and the business affects the crude oil prices. An increase in industrial metal prices generally indicate business expansion along with gold. These industrial prices have long-term component that coincides with the gold price and give more options for investments during a period of hard assets. Figure 29.3 shows the relationship between industrial methods and stock market. Let's look at that. Okay, S&P 500 industrial methods. What does this mean for investment selection? Being in the time period for following the 2012 signal, for the switch to soft assets suggests that analysts should be concentrated on those investment concerned with stock market or bond market. Obviously, by looking at the charts, you can decide on where you want to currently in this market conditions invest in hard assets or soft assets. Now we have cyclical emphasis. You know that there are various cycles, right? So within the longer secular economic trend are similar to business cycles. These business cycles are of varying length but usually average around 4 to 5 years. These business cycles are normal horizon for most economists, business managers and investors. It is well recognized that the leadership in the trading markets often switches within the business cycle. This appears to be a standard pattern that is worth watching. Murphy maintains that although the markets may appear independent, they are interrelated and follow certain patterns. For that reason, he suggests that investors should be aware of all these markets and their interactions. The activity in all of these markets might offer suggestions about investment prospects. Martin Pring 2002 classifies investment markets into three categories: commodities, bonds, and stocks. Murphy adds currencies and, to some extent, foreign stock markets to this list. The business cycle affects each of the markets but in different ways. Let us look at the normal sequence of leadership among these investments and see how to recognize when a change in leadership has occurred. We will look in sequence at dollar rate to gold, using gold as proxy for inflation and commodity prices, gold futures. Okay, so basically all the markets are interrelated to each other. So the reason why I read this out was so that you understand what Murphy has actually said and how we are going to basically use the this in order to select our issues. Now let's talk about the US dollar and gold. Before we actually talk about the US dollar and gold, you might be aware that the pair, if you want to trade gold and forex, then it is known as the uh, XAU USD. So it is always measured against the rate of the dollar, right? Murphy maintains that currency rates influence industrial prices but sometimes with a considerable lead. The dollar is most important in that it is the pricing currency for many of the world's raw materials such as oil, gold, and other precious metals. When the dollar declines, it makes these commodities cheap in foreign currencies but expensive in dollar terms. Thus, there is a leading inverse relationship between the US dollar and the raw material prices in the United States. In figure 29.4, we use gold as a proxy for industrial prices because gold has a well defined price. So, this is the price of the gold future chart you can see, and this is the US dollar. When gold was rising, US dollar was kind of falling. So, that is something you need to keep in mind. Okay, so you can see one more thing that when the ratio is rising or the dollar is stronger than gold, then gold tends to decline and vice versa. That's what I just explained to you. We use a trend line as the means of generating crossover. Look at this. They have a trend line over here at the ratio. So the moment there was a breakdown of the trend line, you can take trades based on the trend line itself. Whenever it went here, you know that the gold is going to go further up because US is going down, US dollar is going down. So if you see that there's going to be a downturn in the US dollar, you know that the gold is going to go up. Alright, now let's talk about